Over the last couple of weeks, the Nasdaq has come under severe selling pressure, with the tech index on track to finish September down over 5%. The turning point was last Wednesday's Fed meeting, which, although no rate hike was announced, Fed Chair Powell hinted that more rate hikes were on the horizon and that rates may remain higher for longer than previously expected. If we look at the daily chart, we can see exactly what that did to the technical picture. Right here is when the Fed announcement was made about keeping rates higher for longer, and price confirmed the key technical moving averages, the 20 and the 40 day, as resistance. Price was already vulnerable after the close from the prior week on the 15th of September, which saw price break down below these moving averages, but it wasn't until the Fed day where the selling really started. Take a look at this chart where you can see the 10-year yield take off, whilst the Nasdaq 100 tanked. This was the point where the Fed announcement was made. Since then, it's been very much a yield story. The 10-year yield has been hitting levels not seen since 2007, and that has really hit the Nasdaq. Money continues to pour into treasuries despite the poor performance. So why have yields reacted so aggressively since the Fed announced it will likely require further rate hikes and higher for longer? The price of crude oil, which is a major driver of inflation, has rallied in recent weeks, and oil is now above $90. That signals potential for inflation to rise again in the coming months, which would mean the Fed would have to continue to raise rates to combat that. The chart here shows the 10-year and oil have been trending higher. Fed official Kashkari also talked up the prospects of further rate hikes on Tuesday, as did JP Morgan chief Jamie Dimon, which is what triggered the move down in price to test a weekly trend line. From previous videos, we've shown how this weekly trend line is formed, connecting to the highs from November and December 2021. On Wednesday, a doji was formed, highlighting the uncertainty in direction, with price testing and holding 14,550 support. This was called out in my Twitter post last week as a level to watch on the downside. The hold on Thursday of this support level again was a positive, which brought buyers back in. You can see from this chart as well that the 10-year peaked out on Thursday and eased off the highs, which helped push the Nasdaq 100 higher. That push higher yesterday is seeing some follow through today as we close out the month. However, yields are not the driver today, and instead it's fears of a government shutdown, which is hitting sentiment, with debt ceiling needing to be raised yet again. Hedge fund manager Ray Dalio talked up the prospects of a debt crisis emerging in the US. Rates are high and are likely to stay there for some time. Debt levels are at record levels, which is a bad mix, as the interest payments are going to be higher in a high rate environment, which is why the US government is on the verge of a shutdown. Going back to the charts, if we look at the daily chart, 14,550 is key support, followed by the weekly trend line in red. Now price remains above these levels, so the selling is likely to be capped for now. A breach of the weekly trend and the selling accelerates, with 14,250 the immediate downside target. It should be noted on the weekly chart, September's move just looks like a backtest of the breakout in the Nasdaq 100 from August. This weekly trend is key to determine the next move. October's gearing up to be a pivotal one, which will dictate the trend for the rest of the year. It should be noted that this move down is simply a liquidity drain from the Fed, which is highlighted in this chart showing how the balance sheet and the S&P 500 are tracking lower. Next week we have Fed Chair Powell speaking, as well as the monthly jobs report and the ISM Manufacturing and Services PMI, so that'll be the focus. With that said, thanks for watching. Remember to hit that subscribe button so you don't miss out on future content, and I'll see you at the next one.